Most beginners lose money not because they're unlucky, but because they jump into investing without a clear plan or strategy. They hear a hot stock tip or see the market moving, and they rush in, only to panic and quit when things don't go their way. The truth is, successful investing isn't about guessing right. It's about building a smart foundation and sticking with it over time. If you've ever felt overwhelmed by the world of finance, this video is for you. I'll walk you through 5 simple and practical steps to start investing smart, even if you're a complete beginner. By the end, you'll understand the mindset and tools that can actually grow your wealth instead of draining it. And hey, welcome to Beacon Capital Finance, where we break down finance into clear, actionable strategies anyone can follow. Be sure to subscribe so you don't miss our weekly tips and guides. Step 1. Define clear goals. The first step in any investment journey is clarity. Without clarity, investing feels like throwing darts in the dark. Ask yourself, why are you investing? Is it for retirement, so you can live comfortably when you're older? Do you want to buy a home in 5 years and need a safe place to grow your down payment? Or maybe your goal is simply to build long-term wealth and create financial freedom. Think about it this way. If you don't know where you're going, any road will get you lost. Goals act like your GPS. They give you direction and purpose. When you set a clear destination, every financial decision you make becomes easier. For example, someone saving for retirement might choose long-term, stable investments like index funds or bonds that grow steadily over decades. On the other hand, someone saving for a house in just 5 years may lean towards safer, short-term investments that protect their money while earning modest returns. The strategy changes based on the goal. Here's a practical step. Grab a notebook or open a notes app and write down your financial goals today. Don't just say, "I want to save money." Be specific and measurable. For example, I want to save $20,000 in the next 5 years for a house down payment. Or, I want to invest $200 per month for the next 25 years to build my retirement fund. Once your goals are written down, you have something concrete to work toward. Clarity doesn't just guide your investment choices. It keeps you motivated when the journey feels tough. And remember, every other step in investing becomes easier once your goals are crystal clear. Step 2. Build an emergency fund. Step 2 is all about protection. Building an emergency fund. Before you start buying stocks, crypto, or any other investment, you need a safety net. Life is unpredictable. Cars break down, jobs get lost, and medical bills pop up out of nowhere. If you don't have cash set aside, you'll be forced to sell your investments early, often at a loss, just to cover those emergencies. An emergency fund acts like insurance for your investments. Most experts recommend saving at least 3 to 6 months' worth of living expenses in a separate, easily accessible account, like a high-yield savings account. That way, if something unexpected happens, you won't have to touch your investments. Let's say your monthly expenses are $2,000. That means your emergency fund should ideally be between $6,000 and $12,000. It might take time to build, but even starting with $500 or $1,000 can give you peace of mind. Here's the key. Keep this money safe, not invested. This is not about growth. It's about stability. When you know you have a financial cushion, you can invest with confidence, without fear that one surprise expense will derail your entire plan. Step 3 is understanding risk and diversification. Every investment carries some level of risk. The stock market can go up and down daily. Bonds are usually safer, but they may not grow as fast. Real estate can be stable, but it requires a lot of capital and time. The key is to balance your risk by diversifying. Diversification simply means not putting all your eggs in one basket. Instead of betting everything on one stock or one asset, Spread your investments across different types of assets, like stocks, bonds, real estate, or even global markets. That way, if one area struggles, the others can help balance it out. Think of diversification like building a team. If one player has a bad day, the whole team doesn't lose. Your portfolio works the same way. Here's a simple example. Imagine you invest $10,000. Instead of putting it all into one tech company, you might put $4,000 into a broad index fund, $3,000 into bonds, $2,000 into international stocks, and $1,000 into cash or a money market account. Suddenly, your risk is spread out, and your chance of long-term success is much higher. Understanding risk also means knowing yourself. How would you feel if the market dropped 20% tomorrow? Would you panic and sell everything? If so, you might want a more conservative portfolio. But if you can handle the ups and downs, you can afford to take more risk for potentially higher rewards. Diversification doesn't guarantee profits, but it's one of the most powerful tools to protect your wealth and grow it steadily over time. Step 4 is to start small and be consistent. Many beginners make the mistake of thinking they need thousands of dollars to start investing. The truth is, you can begin with as little as $50 or $100 a month. What matters most is not the size of your first investment, but the habit you build. Consistency beats timing. Some people try to time the market, waiting for the perfect moment to buy. But even the best professionals can't predict the market perfectly. Instead of waiting, focus on starting now and contributing regularly. There's a strategy called dollar cost averaging. This means investing a fixed amount of money on a regular schedule, no matter what the market is doing. Over time, this approach helps smooth out the ups and downs. When prices are high, your money buys fewer shares. When prices are low, your money buys more. In the long run, it can lower your average cost and reduce the risk of bad timing. Think of investing like going to the gym. You don't get fit from one massive workout. You get results by showing up consistently over months and years. Investing works the same way. Small, steady contributions grow into big results through the power of compounding. Step 5. Keep learning and stay patient. The fifth and final step is to keep learning and stay patient. Investing isn't a one-time event, it's a lifelong journey. The market will rise and fall, news headlines will come and go, and new trends will always appear. The investors who succeed are not the ones who chase every new opportunity, but the ones who stay disciplined, keep learning, and stick with their plan. Knowledge is power. Read books, watch educational videos, and stay curious. The more you understand about how money and markets work, the better decisions you'll make. But just as important as learning is patience. Building wealth takes time. Compounding works slowly at first, but then accelerates. For example, if you invest $300 a month with an average return of 7%, in 10 years, you'll have about $52,000. But in 30 years, you'll have over $360,000. That's the magic of patience and consistency. The hardest part of investing is often controlling your emotions. Fear and greed can lead to poor decisions, like selling during a downturn or chasing risky opportunities. The best investors learn to stay calm, stick to their plan, and think long-term. So let's quickly recap the 5 steps. Define clear financial goals. Build an emergency fund for protection. Understand risk and diversify your investments. Start small but stay consistent. Keep learning and stay patient. These 5 steps form the foundation of smart investing. Remember, you don't need to be a financial expert to grow your wealth. You just need clarity, discipline, and consistency. And again, welcome to Beacon Capital Finance, where we break down finance into clear, actionable strategies anyone can follow. If you found this video helpful, hit the like button, share it with a friend, And don't forget to subscribe for more weekly tips that can guide you on your path to financial freedom.